This podcast is brought to you by Knowledge Wharton.
And we are joined now by Catherine Mann, who is the Global Chief Economist at Citi. Welcome. Thank you very much for your time today.
Great to be with you.
How future ready are organizations in America right now in the scope of where other companies and countries are around the globe right now?
Well, that's really a big question because we really have to differentiate firms by which sector that they are in, which country that they are in, because some of them are ready and some of them aren't. I mean, some of the countries are readier than others. So it's really hard to make a blanket statement on who's future ready. Do we want to parse it down? How would we like to parse that down?
But it is important to have the understanding that it is an important component moving forward for companies to think about the future, think about how they need to adjust what they do on a day-to-day basis so that they can be competitive on the global stage.
Yeah, but right now the global stage is really changing quite a bit. For companies to know how they should be preparing themselves for the U.S. marketplace or the European marketplace or the Chinese marketplace, I mean, the parameters of how much global engagement there's going to be, what the policy rules of the game are that firms have to respond to, those really are in flux right now. I mean, there are some basics, right? Firms need to pursue innovation. But, if you don't know which market you're going to be in, which consumers are going to need your products, which other businesses might be buying your services, it's really kind of hard to know exactly where to put those major efforts are in terms of innovation. We all know that we really want to have workers that are first class and are working with the first class materials, whether it be services or capital. Right. But again, if you don't really know where your market is going to be in the future, which one's the one that's going to be growing the fastest, which ones that you're actually going to be able to participate in, it makes it very, very hard for businesses to make themselves future ready.
And so that's part of the reason why we see companies holding back on business investment in certain circumstances, correct?
Well, I think that we are definitely looking at a situation where firms, 6 months ago, U.S. firms in particular, were looking out at a 5-year horizon, and they were making judgments about how to pursue a capital investment plan. And by capital investment, I mean just, tangible and intangible capital. It's not just building a new plant or something like that. It's also intangible capital. And they were looking at a situation that was characterized by significant labor market shortages in many advanced economies, the U.S., Europe, Japan, Sweden. And they were looking at a strategy that said, if I want to meet my demand going forward, I really have to put into place a capital investment program that either substitutes for the workers that I can't hire, or I need to put into place a capital investment plan that will make the workers that I am hiring competitive and skill ready for what I want. So they had in place a capital investment plan for workers. They also had in place a capital investment plan looking forward for where their expected market demand was going to be for their product or services in global marketplace as well as in the U.S. marketplace. That was, say, 6 months ago. They knew that the trade issues were out there on the horizon. It was a little choppy water, but the view was, we're going to see through this and follow through with our long-term plans, our 3 to 5 year plans. Well, recently, things have really changed, and firms, particularly those that have been examining the external marketplace, have really changed their prospects for what capital investment plan is going to be appropriate, because they think the future is going to be less bright. And it's maybe you call it the near-term future, the 3 to 5 year future. But of course, if they think the near-term 3 to 5 year future isn't bright, then that makes the immediate less bright as well. Because if they undertake a slowdown or if they pause on their investment strategies, it's not good for the workers, it's not good for their market. We worry very much about how today's environment colors businesses' strategies to prepare for the future, and that will change the future.
So we talk about being future ready in the scope of the United States a lot, But how frequent is this conversation going on around the globe, do you think?
This conversation is happening in every single boardroom. And every single policy authority as well, because the two of them are, do have to be thinking about each other's moves. And but there's no question that around the globe, the boardrooms are assessing how they should be. How is the future going to be different? Well, I mean, we know there's some issues with, some certainties are climate change, right? That's a certainty. But what the boardroom is less certain about is, what do we think the policies are going to be going forward to which we should be responding? What are the prospects for a carbon tax? Economists, not everyone, but the vast majority of economists believe that a carbon tax would be the easiest strategy to change relative prices of energy sources that would lead to a significant change in business investment strategies. It would be a way in which policies could change that would create an innovation ecosystem in countries that are ready to take advantage of innovation opportunities. And those countries would be more future ready in the context of climate change. So that we know.
Yeah.
Some of the other things that we're less sure about, though, in a business context is, again, the trade war. It's a very immediate issue. It has escalated. It has persisted. And there's this growing sense around the world that this is the new landscape for global trade. And I might add, this trade tensions that are between the U.S. and China principally, but of course have metastasized to all sectors and to all economies through global value chains. We can look back and say, globalization and metrics of globalization, trade integration, financial globalization, those metrics of globalization stalled more than 10 years ago. So we have been working in the business environment. It takes some time to sort of, for these things to break into the boardroom view. But, globalization stalled 10 years ago. Now we're seeing it in retreat, raising protectionist barriers. And if you look at it pretty dispassionately, you can sort of say, this is the new landscape. And how should I change my business strategy for a new landscape that has less global integration than we did in the 2000s and before that?
Catherine Mann is the Global Chief Economist with Citi. She joins us here on the show. Knowledge Wharton here on Sirius XM 132 Business Radio, powered by the Wharton School. I think a lot of people believe that when you're talking about companies trying to be future ready, part of the discussion has to be, and you alluded to it before, is the personnel and the skills that those people have, and what we need to do as a company, as a country, as a lot of different elements to make sure that those workers are ready to take those skills and take that next generation of jobs.
Yeah. Well, so certainly, I mean, fundamental for a country to be future ready and for firms to be future ready as well is the quality and characteristics of the labor force. In advanced economies, it's particularly important to be considering this because the overall demographic profile is one where labor force growth has slowed dramatically. So if you have fewer workers, you really want them to be good. And you really want them to be ready and skilled for the investments that businesses are put into place. So there, of course, are some challenging statistics when we look at American workers relative to those around the world. If we rolled back and dialed back our examination to, say, the 70s and the 80s, 1970s and 1980s, and we compared the educational attainment of the average American worker, to compare that to their counterparts, his or her counterpart in other parts of the world, we would see that the educational attainment of the U.S. worker was much higher on average, and even in terms of distribution. So it's not just an average, but in distribution compared to workers around the world. So the U.S. labor force had a real edge. That's not true anymore.
Right.
And in part, it's because educational attainment of workers abroad has really caught up.
Right.
But it is also the case that educational attainment of the average U.S. worker, if anything, has slipped some. And that is definitely a challenge when you're at a time, as I say, in terms of demographics, you want to have all of your workers to be really increasing educational attainment as opposed to flattening off. We have to talk about what does educational attainment mean.
Yeah.
It may not mean a 4-year college, which of course has been a very important ingredient in workers' outcomes, wages. Workers who have 4-year degrees tend to have higher wages. But going forward, there's a sense in which 4-year colleges may not be the right recipe,
Right.
Much more targeted strategies. And that's where partnership with business is really important, because businesses do know what kind of skills they need, and having that communicated effectively through an educational system so that the educational system can deliver the right kind of training and education, that's a super important ingredient for the United States. And it doesn't, it hasn't quite gelled yet.
But I find it interesting that, at how important the education piece is to moving forward, we still are at a time where a lot of companies are hesitant in adding training within the company itself. They're worried about giving that training and then that person going to another company. They're worried about
poaching.
That loss of HR. Then they have to add in to their bottom line HR. So it's a unique dynamic of wanting to invest in education or invest in skills, yet be worried about losing that employee 12 months, 24 months down the road.
Well, that is definitely a key challenge. And it's an example of where sort of collective incentives, if you could get everyone to ramp up on their training,
right.
then everybody does a little bit of an expenditure, for sure, improves the quality of the workforce, better matching to the skills that are needed. And if everybody's doing it, you're less likely to be poached. And effectively lose that investment.
Yeah.
So, what kind of incentives can you come up with that enhances the likelihood that firms are really going to engage in this? And, I can go back to something that I recommended back in the 2000s, actually. It was called a worker tax credit. And we would talk a lot about investment tax credits for capital investment.
Yeah.
How about a worker training tax credit?
Yeah.
Effectively, it subsidizes. I mean, that's another word, but investment tax credit sounds a lot better than subsidy.
We're joined by Catherine Mann, Global Chief Economist at Citi. You're listening to Knowledge Wharton here on Sirius XM 132, Business Radio powered by the Wharton School. So then, if we need better policy as one of the components of this, one of the things that I've talked about is at times what seems to be a gap between where the push for policy is and where the expectation of business is right now. And I think trying to close that gap is probably as important as anything at this point.
Well, I think it is. The challenge is, of course, that business has to make decisions. I mean, they don't get to dither around when making business decisions. Either they undertake an investment program or they decide, no, the timing is not right and we're not going to do it.
Right.
There's a consideration on it, and there's obviously a lot of discussion, but they do take the policy environment as a given. So if the policy environment is a very slow-moving situation, and business decisions have to move forward more quickly, we end up with definitely the more likely outcome that things are worse off than we would hope,
right,
as opposed to better off. You end up with sort of the, in economist's language, a low-level equilibrium where firms do not train, workers are not well matched,
right,
wages are lower because the match is not good, productivity as an outcome is less than we would hope for, and so you end up with this low-level equilibrium where firms are not as good as they could be and the workers aren't getting paid as much as they should be. And that's not where we want to be.
It seems, though, that we do significantly benefit from the fact that we're in a time right now where, let's say it's a publicly traded company, investors are more thoughtful about where the company needs to be going, that future-ready perspective. Consumers in general, I think, in today's day and age, are more thinking about the future. I think from general, we benefit from those two components being at play here for our companies and our policymakers then to bring us forward.
So I think one specific example of where, in some sense, the markets are taking over for the policymakers is in the context of ESG. ESG standards, and there's quite a bit of additional, new, ongoing, but developing interest in ESG companies, and looking at the returns that ESG companies or firms that are designated ESG, and of course there's not a single standard of what ESG means, and that's an interesting challenge that companies have. But if you look at ESG returns on publicly traded companies that are designated ESG, their returns are better. Right. Their returns are better and than their comparator companies. And some of that has to do with, as you say, the discipline of the marketplace, meaning the consumer. The consumer is saying, I want certain kinds of things. I want them to be environmentally conscious. I want them to be socially relevant. I want the governance of a company to be transparent. And so I am going to reward companies that follow those metrics. I will buy their products, I will buy their services, and I will buy their stock. And if we're talking equities or bonds, if we're talking their bonds. So the market here is playing an important role in pushing forward the behavior of firms. But of course, it's a process. I mean, not all companies are ESG companies, right? Yeah. So if there was a policy that matched the objectives, then there would be discipline coming from both the policy direction as well as from the market direction.
Are you confident that we're moving in that path right now?
No, I think we are not. I think in the U.S. There's a tremendous lost opportunity when we think about policies with regard to global engagement. Yeah. There are lost opportunities with regard to meeting the challenge of climate change. Yeah. Policies with regard to both of those dimensions are not in a direction that is creating an environment for a future-ready America.
I guess I should have asked, are you confident that we can get to that point at some point?
There is a challenge in the marketplace. I think the marketplace is the consumers and investors are stepping up to this challenge. But in order to be future ready, you have to have both the policy environment as well as the market in sync.
Catherine, thanks very much for coming in.
Thank you very much.
Catherine Mann, Global Chief Economist at Citi.
For more insight from Knowledge at Wharton, please visit knowledge.wharton.upenn.edu.